All right, everyone, we will get started for the November edition of the Director's Cut. As you can see, we are once again joined by Tax Commissioner Ryan Rauschenberger, so thank you very much for being here, Commissioner Rauschenberger. Rules of the road, since we have a lot of new callers on, please try to keep it on topic as far as the Director's Cut or what's listed on the handout from the Commissioner's office. Those are my rules. If you need to ask questions, please use the chat feature. Other than that, we will start off with Mr. Helms, who will give us some comments, and then we'll turn it over to Mr. Rauschenberger, and then we'll open it up for comments. So with that, Mr. Helms, take it away.
Thanks, Allison, and thank you, everyone, for attending or logging on for the Director's Cut. This month's theme is about the trigger, and so I chose Happy Trails to You. That's the tune that Roy Rogers used to sing at the end when he wished everybody goodbye, and of course it always ended with "Until we meet again." And of course there still is an upside trigger at $90, so we'll go with that for a theme this month. A few points that I want to touch on with regards to September production: a pretty significant drop in production, a little over 25,000 barrels a day. Just over 2% decrease, and that's sending a definite signal to the market that oil and gas operators are not willing to do a lot of drilling or hydraulic fracturing or produce oil at these low prices. And so I think there's a market signal going on there, and companies have cut deeper than what they anticipated going into this year. Even natural gas production is down. It's down almost 2%, which means the gas-oil ratio is up because they're drilling in the core area. So gas production did not fall as much as oil production, but it still did drop from August to September. We also saw a decrease in the number of active producing wells, and we haven't seen that since December of 2013. So almost 2 years, and of course that was a winter month and often a difficult weather month. So very, very unusual to see producing wells drop in the August to September time frame. We have not seen that since 2003. So that gives you some idea of what the economics are doing in terms of oil company philosophy and producing philosophy. We haven't seen August to September producing well numbers drop since 2003. So it's been 12 years since that happened. Also seeing natural gas prices very, very low. Not only have oil prices dropped, but natural gas prices have dropped with the mild winter weather. We're at under $2 going into the northern border at Watford City, and it's been probably over a decade. I meant to look that number up, and we can get one for you if need be, but I believe it's been over a decade since we've seen natural gas prices that low. Just want to point out in the federal rule section of the Director's Cut, the rule to replace onshore order number 4, comment period is still open for that one, I believe, until the 30th of this month. And November 30th. The Industrial Commission approved comments yesterday. You can request a copy, or they'll be showing up on the Industrial Commission website within the next couple of days. The rule to replace onshore order number 5, which is about gas measurement, that comment period is open until December 14th, is it, Allison? I can't remember. I'm looking for it in here. But again, the Industrial Commission approved comments yesterday, or you can request a copy from the Department of Mineral Resources. And then finally, there's another major rulemaking, the EPA's suite of methane reduction rules that's out there, and they extended that comment period through December 4th. And so the Industrial Commission kind of preliminarily approved comments on that one yesterday, but they have to be circulated. So once they get a signature from each of the 3 commission members, they will be approved and submitted, and you can check back with Department of Mineral Resources to look for those. Last thing I want to talk about is we're updating this month because it's the end of a quarter, July, August, September. We're going to be updating our break-even prices. And I think you're going to see, pretty significant change Our estimate for wellhead price for North Dakota crude oil is $40. That's based on averaging the Flint Hills Resources North Dakota sweet price and WTI that usually is within $1 or so of actual price. And what you see now is only 3 counties that are positively below that break, or that have a break-even price lower than that $40 number: Dunn, McKenzie, and McLean. The other 3 major counties are kind of hovering close to that, and commentary on that: Mound Trail at 46, Stark at 42, Williams at 44. The problem with those counties is that there's sort of an east-west or a north-south phenomenon going on there. So if you look at Mound Trail County, the southern end of Mound Trail has a break-even price, more like McKenzie or Dunn in the $30 range, but the northern end of Mound Trail County is higher, and so the average appears to be above current oil price, but you still see a lot of activity in the southern end of Mound Trail. Kind of the same thing going on in Stark. The western end of Stark, low break-even price, eastern end high, and Williams County just the opposite. Western end, high break-even price, eastern end, a low break-even price. But we're starting to see even some of our major producing counties at or near that break-even oil price. And so you see that reflected in a slight decline in rig count, and you see that reflected in an increase in the non-completed well count to over 1,000. And so oil companies are restricting investments and completions and drilling, and you see it reflected in the daily production numbers.
Okay. Mr. Rushberger, would you like to provide some comments as to why you are here today?
Well, great. Well, first of all, thank you for having me here. I am back again to talk once again about triggers, specifically the large trigger. And what I'd like to do, for those of you who don't have really a background, and I think everybody has that handout, but for those of you who are not familiar with the tax structure in North Dakota, I just want to give you a quick background of how that works, and then talk about why I'm here to talk about the big triggers today. In North Dakota, we have 2 tax types on the gross production of oil. That's the gross production tax and the extraction tax. The gross production tax is 5% of the gross value of oil produced out of the ground, and the extraction tax is 6.5% of the gross value of oil produced out of the ground. Every barrel in the state is subject to the gross production tax, but the extraction tax is essentially the tax that has a number of incentives associated with it. And the one I'd like to talk about today is the big trigger. That is the large incentive that comes on and off based on the price of oil. So the big trigger would essentially get rid of the oil extraction tax for most production in the state if that were to hit, and that would come in effect if we have prices below $55.09 on the NYMEX for 5 consecutive months. And that's the key, is it's not just 5 months throughout the year. It has to be 5 months consecutively below that number. And because that is such a large, tough threshold to hit, that's why we call it the big trigger. And there are a number of incentives associated with the big trigger. What I'd like to do, the main incentive that's associated with the big trigger is the exemption of extraction tax for horizontal wells. So basically, if that big trigger were to hit, under current law, that means that most production in the state would be almost completely exempt from the extraction tax, and that's the 6.5% tax. So, and that is actually the norm. That exemption was on from 1987 to 2004. It came off in 2004 when prices started to rise. So it's only been, most oil in the state has only been subject to the extraction tax since 2004. So for the last 10 years, big trigger has been off because prices have been relatively high. Now we get to this year, 2015. I've been watching the big trigger very closely as I've been here a number of times talking about it. Since January, if you look at your handout, I just want to kind of take us through the year briefly. If you look at January, that was our first month below the trigger price of $55.09 on the NYMEX. We were at $47.98. February, we were just above $50. March, $47. Then April just snuck in at $54, just below the $55.09. So we had 4 consecutive months, but then we hit May. We were at $59, 47. That was after the legislative session was over. We ended up not hitting the big trigger. A lot of people thought we were very close to hitting that. We did not. But then you look at June was still above, well above the big trigger. Then you hit July. Prices dropped again. The NYMEX averaged $51.45, August $43, September $45, then October $46. And so far, we currently have 4 consecutive months. But now you look at November, we've still been consistently below $55.09. The average as of yesterday's closing price was $45.09. So essentially, we'd have to be well above $60 for the rest of November for us not to be at that 5 consecutive months. So that's what's key. November 30th would be the final date to hit the big trigger. Now, there are many parts to the big trigger. There are some major portions and some more minor targeted incentives. I'd like to cover House Bill 1476 because there are different parts of the big trigger that will go away from law on November 30th, and different parts of the big trigger that will go away December 31st. So December will have a different treatment than November and January. So that's very, very key. So there's kind of jumping through some hoops to get to January 1 where we have a new tax structure. So what I'd like to do is talk about House Bill 1476 for you, kind of run through what that bill did, and then I'll talk about a few of the, I should say, the more minor incentives that are going to be in place for December based on the big trigger. So House Bill 1476 passed earlier this year amidst the lower oil prices that we had coming into the legislature in late April, which was the 4th trigger month when we thought we were going to hit that 5th trigger month. House Bill 1476, the major part of that bill is it repeals the large portion, it repeals the incentives tied to horizontal wells, new horizontal well production in North Dakota as of November 30th. So the big trigger is still in place, but the major incentive portion of it tied to horizontal wells goes away November 30th. So interesting timing that the very end of the 5th month to the 5th consecutive month to trigger, the major portion of the incentive goes away in law. So at November 30th, when we actually would trigger these incentives on, the major portion of the incentive that is associated with the extraction tax exemption for horizontal wells goes away. So very interesting timing. It doesn't help explain it because you have two things going on at once. The big trigger essentially kicks on November 30th, but at the same day, the horizontal well exemption is now no longer in law. It is out of the Century Code. So that being said, there are still some exemptions that are allowed in law. Some are triggered, some are not triggered. First, secondary recovery, different water flooding, CO2 tertiary recovery, the stripper well exemption. These have all been on the books for a long time, and they're still allowed in code. And then a non-Bakken drilling incentive is still allowed in code. Before I talk about what happens in December, I just want to clarify I think it'll be easier to talk about January going forward first, so I don't cloud up the issues we have with December. Starting on January 1, the extraction tax goes from 6.5% down to 5%. That's our normal extraction tax rate. And that's reduced from the current 6.5%. However, we now have what's called the high price trigger, which basically, if we have the NYMEX price be $90 or more for 3 consecutive months, the extraction tax goes up to 6% from 5%. So our top rate in North Dakota would be 11%. But that's only in the case of high prices. It's interestingly, we did some analysis and showed that high price trigger would have actually come into effect 5 different times since 2008. So a lot of people weren't sure if this would ever come into effect, we would never hit prices that long, the high prices for that sustained period of time. It would have been in effect and out of effect 5 different times since 2008. So I think that's important to note that it isn't unlikely that will, of course, happen sometime in the future. It's not if it will happen, but when it will happen. So we do still have, going forward from January 1, that's a whole new tax structure. A new extraction tax rate of a normal rate of 5%. The big triggers, all the triggers go away. and we just, except for the high price triggers. So the incentive triggers go away. Now, as of for December 1 through December 31st, we still have 1 month of certain portions of the big trigger in effect. So when we hit the big trigger, which I believe we will at the end of this month, we will have certain targeted incentives that are tied to the big trigger go into effect. Again, not the horizontal well incentives, but a number of specific more minor incentives that are targeted for older and lower producing wells that will be in effect for just 1 month, and then they're gone. So I do have those listed on the handout. They're bolded under the second major heading. So the following incentives are repealed after December 31st, but will be effective for oil produced during the month of December. So again, we stay at this constant oil price, in the mid-40s through November. These incentives will be in place for 1 month. Production from a qualifying well has been worked over. There are a lot of different metrics that a well has to meet. It has to be below 50 barrels a day for 6 months. There has to be a certain amount of expenditure for that to happen. Again, it's for lower producing wells and particularly older wells. We have a 2-year inactive well incentive. If a well comes out of inactivity after 2 wells, it's reworked, that is potential incentive available, again, just for the 1 month. A reentry well, if there's a horizontal well, actually, if there's a vertical well that had an offshoot for a horizontal leg, that is potentially eligible for an incentive, again, just for the 1 month. New vertical well incentive would be available just for the 1 month. And then certain incentives associated with non-incremental oil from an enhanced recovery well. So those are very targeted incentives. I consider them minor compared to the horizontal well incentive that goes away on November 30th. The way to look at it is 95% of all production in the state is from your Bakken Three Forks wells, and these are really associated with that last 5% and really a fraction probably of that last 5%. So when I say they're minor, I mean that they are very targeted and very minor, and most of these are dependent on certain activities taken by the oil companies themselves, like going into an inactive well, going in and bringing out a workover rig on certain wells that would qualify. So technically, the big trigger's in place, but only the minor portions of the big trigger. So that's one thing I really want to get across. But again, I would say that the most important thing here is that starting January 1, all of those triggered incentives go away. We have an extraction tax rate of 5% unless oil goes above $90 for 3 consecutive months. And then we have the 6% top rate. That being the case, I think I'd be happy to try to take any questions if we're at that point.
Okay. I don't have any that have come through yet in regards to the trigger, but I would just like to say after that explanation, I am very glad that you were here. Thank you very much for coming. So we'll wait for those questions to come in. As I wait on those, we'll get to some of the question, unless there's any in the room. We can take those right away. I was just curious if you had an estimate on about what that might translate to in December, money-wise, if all that kicks in revenue, what kind of shift in revenue that might entail.
That we have talked about that I'll repeat the question. Sorry. The question was, what would all those more minor incentives, if they kick in December, what would that equate to from a fiscal standpoint? I would call it, again, we don't have a number really tied to it. It depends on what the producers decide to do, whether or not it's really, whether or not this activity would actually take place. That they have to essentially provide us that information. It's not something that would just automatically kick in. Most of this would be something, again, that the companies have to proactively do and apply to us for. So it is really unknown, but based on my explanation earlier, the vast majority of production in North Dakota is not eligible for this. It's very, very targeted. The impact would be very small.
Okay.
I believe we did a check this morning, and we don't have applications for anything in any one of those areas in the department at this point in time. We'll give you an update at the end of December to let you know if any of them came in. But at this point, nothing, no applications from industry for any of those lesser tax incentives that would kick in. So.
This is a question for Ryan. I think you should clarify. The question is, do you know how many vintage rigs are eligible for the incentive? And so I guess the question is more appropriately, are rigs eligible for the incentive? And if so, how many?
I guess the question, how many vintage rigs?
Yeah.
I'm not quite sure if I understand the question. I don't know if Lynn or if
well, I suspect that the question is talking about drilling rigs that are drilling something other than Bakken and Three Forks. And the update that I received earlier this week was that there were only 2 rigs drilling wells to oil-producing formations other than Bakken and Three Forks out of the 64 active rigs. And one was drilling a Dakota disposal well, so that wouldn't count. But there are 2 rigs actively drilling non-Bakken and Three Forks wells, and they might qualify for example, for the 75,000 barrels for a well outside the Bakken and Three Forks.
I think that's a good point, that those vintage rigs that are not drilling Bakken Three Forks, if they're outside of the geographical boundaries of the Bakken Three Forks, they could be eligible for the incentive that was put in place back in 2013, which is 75,000 barrels, and it's a reduction from 6.5% down to 2%. That's still in code. There's nothing changing there. So there are, from time to time, there's maybe a rig or 2 that would be eligible for that incentive. So that's a good point.
Any questions in the conference room?
Sure. What's sort of the thought process behind going from this triggered system of incentives down to just keeping it at 5% unless the price of oil hits $90?
Well, I guess I'll take the first shot at that one. I think what is the rationale basically to get rid of these, we'll just say the large trigger, and going to a flat tax rate, essentially one that would remain around 10% as opposed to one that would fluctuate from 11.5 down to 5 and back and forth over time. I think a lot of it, both from the state standpoint and from the industry standpoint, is certainty in tax rate. I think it's fairly unique if you look at the tax structures across the United States. That there are incentives for certain drilling activity, but you know that when you're going to go out there, as opposed to an arbitrary NYMEX oil price just all of a sudden going down, to cutting the tax rate in half, but then all of a sudden prices go up and it's doubling the tax rate again. It can be essentially kind of a double swing when you have low prices and then the tax rate goes down by half. You basically have that double hit for the state. But also when it goes back up, that's kind of a double hit for the companies as well. So during the legislative session, it was basically agreed to that the state and the oil companies would rather have a more stable rate as opposed to one that would go off and on. And I will be clear that the trigger's not coming on is a big, I should say, has quite an impact on the state coffers. Actually, if you look at January, taking the last month, taking October collections as an example, if you compare the new 10% rate, the effective rate that would be just below that, because stripper wells are only at 5%, compare what the triggered revenues would have been that month compared to the new flat rate, which is much higher. It's about a $30 million a month additional extraction tax collection because we have a flat rate, not a triggered rate. That's $30 million more costing the oil companies. It's $30 million more in tax revenue to the state. So that's just 1 month, even at the lower production and the lower prices. That's a $30 million swing in 1 month because we did not trigger. So that's was a big policy decision. In this case, it's actually going to be bring in additional revenue, $30 million a month to the state.
Okay, along those same trigger talks, this might be more of a question for Lynn. Would minor incentives have any impact on supply, or could this help boost production?
Well, the question with regards to the minor incentives is probably very little influence on supply. They they boost certain types of high-cost production and help maintain production from marginal wells. But in a world where we're producing almost 1.2 million barrels a day, or in that dynamic in North Dakota, not a really significant impact on production. The second part, dealing with increasing production or increasing supply, is that I think you see industry reacting to the world being very oversupplied with oil and choosing to leave Bakken oil in the ground and store it in the formation in the anticipation that, as you've seen IEA and different ones estimate, oil prices will recover at some point in time and begin to increase, and they would choose to drill and bring wells on at that time.
Okay, that was all I had on the webinar for tax incentives. Unless there's anything that continues on that topic, I'd like to get to some other questions on the webinar. Specifically on the break-evens, could you just speak briefly about McKenzie County, why that went up, and just give some detail on what goes into break-even costs?
Sure. So with regards to break-evens in McKenzie County, probably the primary factor, and it wasn't a huge increase, but the migration of drilling rigs from the shallower parts of McKenzie County into the very deepest part has led to increased well costs and increased hydraulic fracturing costs. So we've seen that break-even price climb some. The best production is being found in the very deepest part of the basin, and those wells are more expensive to drill and complete. I'm sorry, the second part of the question?
What goes into break-even costs?
So the way we estimate a break-even cost is we track the well costs from testimony that's presented at the oil and gas hearings on a month-by-month basis, and we do an annual average. So we're averaging well and completion costs back for 12 months into last year. Then we look at operating costs that are also presented in testimony at the hearings. We have a type curve, a decline curve that we apply for each county. And finally, we look for a 10% return on investment for the operator. We believe that the well has to at least return a 10% return on investment in order to consider breaking even for investment of the money. So those are the main variables that go into estimating those break-even costs. So we run a little computer program and try to look at it on a county-by-county basis. And like I said, if we try to break it out any finer than that, we start to get into confidentiality and information like that. But there are some counties that have a major difference between, say, the north and south half of the county. And so this is a bit of a blunt instrument here.
We're approaching the one-year anniversary of OPEC deciding not to cut production after all that's gone on in the last year. How is North Dakota holding up?
Well, I think North Dakota has seen much more significant reductions in oil activity than we anticipated a year ago when OPEC made that first decision to open up the taps and to flood the world oil markets. And so at that time, our expectation was that we might get down to around 100 drilling rigs. Well, as you can see, we're at 64. At that time, at 100 drilling rigs, we felt like we would sustain between 1.1 million and 1.2 million barrels a day, and that is happening. But we also used what the NYMEX market was saying was going to happen to oil prices, and oil prices are 10% below the market. So what we've seen is continued drilling and improved efficiency in the drilling world, but lots and lots of delayed completions. And so what we see when we look to North Dakota tax revenues, for example, we went back and did some analysis of why sales tax revenues were down so much from oil and gas, and we discovered that 70% of the sales tax that an oil well pays comes in the completion and production phase. So only 30% of the sales tax is being collected at this point as they're drilling and delaying completions on the wells, and they're building that inventory pretty rapidly. We still estimate that they will not significantly go after that inventory until we see WTI prices in the $60 range.
To build on that, there was a bit of an increase in fracking in October and November. Do you think that that is in advance of cold weather?
I think the answer would be yes. Companies are looking at typical North Dakota winter weather and anticipating that and trying to do the things that will maintain their oil production and their cash flow through the December, January, February time frame. And then once we come out of that, then we're back into nicer weather.
Okay. Any light you could shed on who kind of shares the largest share of the ducks?
I actually have not looked at that on a company-by-company basis, so I don't have an answer to that. But I can tell you that McKenzie County is the king by a large portion. And we've got some information that we're putting together that we're going to be putting out with regards to when and where those non-completed wells are.
How fast do you think drilling will ramp up when price recovers?
I actually think that it could take a year. What I'm hearing is that the drilling rigs that have been idled, 100 or actually it's now approaching 120 drilling rigs that have been idled are still in North Dakota. They're parked in North Dakota, but they're being scavenged for parts. And so when it comes time to put one of those back to work, it's going to take some weeks or months to get all the pieces back together, mobilize that, and then get the crew back and up and running. So I think if we saw $70 oil, which is pretty much the price point for adding rigs back into the operating category, it could take us a year to really put those rigs back to work.
Any thoughts on why producing wells dropped in September?
Anecdotally, talking to the oil and gas operators, they are restricting production and shutting wells in and producing only as much oil as they need to make the stockholders and the bankers happy. So I don't have a hard number on that. I don't have the ability to go in and look well by well on this short a basis to see who they are and where they are. But anecdotally, I had the opportunity to visit with some operators over the last half of October and the first half of November, and they are limiting production and leaving wells shut in as much as possible.
If prices, go ahead, Matt. Yeah.
Is that in an attempt to help boost prices back up? Is it because they're having a hard time selling the oil on the market? Why is that? The question is, why are they reducing production? Why are they shutting wells in? And I think at least some of the larger operators are trying to send a signal to the market that they're going to be responsive to these low oil prices and they're not willing to liquidate their assets at these low prices. And then because all of these wells really are economic to produce, even at this price, the break even for operating costs is down in the $15 to $17 a barrel range. So the oil would be economic to produce, but it wouldn't be profitable.
And this kind of continues along those same lines. If WTI remains below $50, do you expect more Bakken producers to go bankrupt or sell assets?
We actually are anticipating that some of the stressed companies are going to be looking to liquidate assets, or that we will see some additional bankruptcies. We've seen two companies who were over-leveraged and overextended that have gone Chapter 11. And our expectation is that if we stay below $50 West Texas into the middle of next year, we'll see some more stressed fire sales, so to speak.
Go ahead, Emily.
Is the Bakken faring worse than other regions now that the price of oil is low, and if so, why?
Yeah, the question is the Bakken faring worse than other regions, and if so, why? And it's a bit of a mixed bag. The Bakken is actually doing better than the Scoop play in central Oklahoma because that's a high water producer, and also the extension of that up into Kansas. It's actually faring better than the Eagle Ford. The Eagle Ford, the oil window was pretty much drilled out at the high prices, and so the remaining locations are in the higher gas oil ratio areas. But the Permian is outperforming the Bakken. We've actually seen production, and we're seeing the EIA project increasing production in the Permian Basin. So the one basin that's outperforming the Bakken is the Permian. The others are underperforming. The Bakken struggles because of our distance from market and our lack of transportation. So our price differentials are higher and our transportation costs are higher, and that's a disadvantage.
How much oil production do you suspect is being curtailed to meet gas capture targets?
Oil production being curtailed for gas capture targets. The anecdotal, and I haven't had a chance to actually go in and work the math, but anecdotally, reports are that it's in the neighborhood of 10 to 15,000 barrels a day.
Okay.
Would the proposed Bakken pipeline ease some of those transportation issues?
Yeah, the question was, would the proposed, and I think you're talking about Dakota Access, the Bakken pipeline to through Iowa?
Yes.
I think we'll probably save that question for Justin.
Yeah.
He's kind of the pipeline.
My expectation is that it would, but let's ask that again when Justin gets up here.
Okay. Sorry, just to follow up on that previous question, was that voluntary curtailment to meet production? Is that what the question was, Allison?
It just specifies oil production.
That's a great question, Emily. Was that voluntary? And in September, we did not impose any mandatory production restrictions. So that 10 to 15,000 barrels a day is voluntary in order to achieve the gas capture goals and not have production restrictions imposed on them.
And have you imposed production restrictions?
We have in the past, but out of September we don't have any. So almost every month, I believe.
The most recent they were for imposed for November was just one company.
Okay.
Okay.
Yeah. So every month, beginning with July of last year, we've imposed production restrictions. Up until the September production, December restrictions, there are none.
There was a production drop about 20,000 the previous month. It's about 25 this time around. We haven't hit winter yet. I would guess it would be due to prices. Would that be the reason? And also, should we be expecting probably some more months like this during the year?
Yeah, the question is the production drop from July to August, and then again August to September. Is that due to prices? And the answer is definitely. That companies are delaying completions, choking wells back, closing wells in. So that's all about price. Should we anticipate more of this? Yes, I think so. I anticipate that we're going to see some pressure on that 1.1 million barrel a day number that the state used for its revenue forecast. We likely are going to get down to that or very close.
And this is probably a better question for both of you, so I'll let you both take a shot at it if you'd like, and then we're close to that deadline. So playing off of the answer to that last answer, what kind of effect will that have on the broader North Dakota economy? Is it more lasting, temporary? Any thoughts?
Well, I guess I'll take that first. I think that I do think that I have talked a bit about the non-oil economy lately to a number of groups, and right now I think there's 17,000 open jobs in North Dakota. 2/3 of them are outside of the oil patch, most of them in the valley. I do think that the lower oil production has had an impact on the economy, but not as much as people would have thought. I think when you look at the lower sales tax, that's mostly because of those inputs and the parts that would have went into oil production. But when you look at a lot of the different sectors, when we compare that to last year, they're still even or even up compared to last year. So the oil impact, the lower prices, I don't think has had quite the impact, the negative impact that people thought that it would have. So that's a good thing. That's a good thing about the diversified economy in North Dakota.
Yeah, I would have to agree with Ryan, and I just want to make one comment to that, though. In the communities in the west, Watford City, Williston, Dickinson, have seen a significant slowdown in building permit applications and construction applications. So the companies who would invest in that type of infrastructure have put their foot on the brakes and stopped adding new investments in those areas. But the overall state economy is still very healthy, and we haven't seen a really major impact. And of course, the legislature and state government learned their lesson from the 1980s, and so oil extraction tax is not something that they fund ongoing expenditures from. It goes into a series of buckets, and then those are used the following biennium after they're collected. They're not revenues that are counted on for general fund operation and projects.
All right. Well, we will end this portion of the webinar. We'll get prepared for Mr. Kringstad. Thank you, Commissioner.
Thank you. Thanks for having me.
For coming.
Ryan, aren't you glad you're not the tax commissioner in Alaska right now?
I am.
But that's just because you love North Dakota so
Exactly.
much.
That's the only reason why. Does that work?
All right, JK,
Okay,
you're up.
excellent. Well, good afternoon, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. We'll get moving right along to slide 2 of my update. Taking a look at what's been taking place around the rest of the Williston Basin. I got some updated numbers for eastern Montana and was a little bit surprised at the level of decrease that I saw in the numbers starting in June and July. You'll see they were trending in the 70,000 barrel per day range, and significant reductions in June and July figures coming out of their oil and gas commission. So we'll continue to watch that because, again, that's crude oil that shares the same transportation network with North Dakota as well as South Dakota. So production changes around the region impacts everyone. The breakdown for September, just very slight changes, August to September. You'll see a slight increase in the percentage of crude being moved by rail relative to pipeline. I'll touch on in a moment why that was, what was taking place in September. Slide 4, if we look at, again, those overall transportation changes, the market share shifts. One thing you'll quickly notice, if you look at this closely, you notice the Brent WTI spread in September was significantly down from historical highs, but again, even relative August to September, that Brent WTI spread was quite narrow. At the same time, that would typically say that more barrels would get onto the pipeline network, but what we saw was more barrels moving on rail. And so what was taking place in September that was unique, it was more of an operational issue. In September, Enbridge, their line 2B was being hydro tested in the month of September. They finished that September 26th. And so that impacted a section of pipe from just north of the border in Canada all the way to Superior, Wisconsin. And so there was limited space for Canadian flows as well as North Dakota flows on that traditional market route. As well, in September, the Northern Tier refinery in the Twin Cities, one of their units went down unexpectedly. And so that market for crude oil in Minnesota was taken away. And so there was also that impacting market trends for that month. And so that will explain what was taking place then with some of those shifts. When we look at just the total or the estimated crude by rail movements, we were just, again, creeping up over that 600,000 barrels per day estimated out of the region for the month of September. So again, a little bit of growth even though we saw overall production decreases, there was increased imports. So we saw even more barrels coming in from Canada into the transportation network, as well as issues on the Enbridge pipeline system. No big shifts on where that crude by rail was heading. Again, the East Coast dominating the market share for where crude by rail is leaving and heading to out of North Dakota, followed up again by the West Coast and Gulf Coast. Pricing update, and no major shifts. Still that East Coast PADD 1 continuing to have the highest priced refining acquisition cost, which is the aggregate or the average price that refiners are paying at these different PADD regions around the U.S. And then as we sit here today, just under $3 spread between Brent and WTI. So coming into October, November, that spread was again less than $3, and so I'm not expecting any major pipe versus rail shifts because of fluctuating market conditions. That's been pretty consistent, sub $3 here for several weeks and a couple months at least. And slide 9, just very quickly showing again increasing volumes of crude oil coming down out of Canada into North Dakota by truck to get onto the transportation network. So we're going to continue to watch this. It's not at an all-time high, but it's getting back up to there to some of the higher levels that we've seen in the past. And so I'm going to continue to look into what's taking place. Is this something we can continue to expect going forward? Because again, just shy of 60,000 barrels a day coming into the region for additional movement, and so that does have an impact on our rail systems, our pipeline systems, and how much is being moved on those two different systems. On the flaring side, we saw a 1% decrease in each of the two categories that I watch month to month. Again, decreases on the amount of gas being flared from wells that are connected, and a 1% decrease in the gas that's being flared for the wells that are not connected. So progress in both of those two categories. Finally, slide 11. Again, the gas capture, getting wells connected to these gas gathering systems in western North Dakota, keeping pace with the drilling activity through the month of September. I wanted to take just a couple minutes. There are some new numbers that I put out this week on what's taking place on crude oil gathering. And so just very quickly to inform those that are interested, what we're looking at on this slide on page 12 is the amount of crude oil that's being moved by truck and being moved by pipe in these various counties and how that's evolved over time. And so there's some good news taking place here in that we've seen some significant progress in the major counties in western North Dakota in getting crude oil off the roadways into gathering pipeline systems. So if we look at McKenzie County, for example, you'll see that from 2013 to 2015, a very large ramp up in the amount of crude oil that's getting put into gathering pipelines. Same with Montreal County, Williams and Dunn all saw significant growth. And if you look at the bottom portion of this chart, that's how much crude oil gets trucked from the well to either a transmission pipeline or to a rail facility. In all but McKenzie County, we saw decreased truck traffic in all three of those non-McKenzie County regions. So McKenzie, it's starting to level off, and I would expect that with current production where it's at and the continued expansion of these gathering systems, that we'll likely see that turn the corner here in the next year or so, and that we're going to get more of these fluids into a pipeline versus on the roadways in western North Dakota. Just from statewide numbers again, historically we've always had the numbers showing that majority of crude oil was trucked from the wellheads. This 2015 data is showing that that's turned the corner, and that now majority of that crude oil is being gathered by pipe versus by truck from these wells. And then just the last slide here on slide 14, just a quick estimate of how many loaded trucks are on the roads in any given day. So you can see again that McKenzie County area, just because of the sheer volume that's produced in western North Dakota, or I'm sorry, in that one county, just shy of 900 loaded trucks each day. And then you also have the unloaded movement, right? So these trucks get loaded, go unloaded at a station, and and then you've got the traffic as well on the unloaded portion. So just to visually show where the concentration is at and where efforts will continue to get more gathering put in the ground to get this crude oil off the roadways. So with that, I'd be glad to answer any questions.
Okay, question from the webinar. Seems the rise in imports of Canadian oil by truck seem to be more than a blip. Any idea what's behind that?
I don't. I've had a couple conversations and some confirmation that it's been occurring. And so whether or not that crude is coming in to access one of the rail facilities, or is majority of it coming in to access one of the pipeline systems, again, given that September had issues on the Enbridge system, those could have been barrels coming into North Dakota to get on a rail system, because that Canadian crude oil, really their only pipeline outlet utilizes the Enbridge mainline system and the Enbridge Canadian system. So it wouldn't be any surprise that the September rise, some of that could have been associated with getting down here to get on a rail facility or get on a rail car.
Why, what's the reason behind the moving away from trucks?
Well, so if you look at, let's get back to some of these counties. So even in McKenzie County, we haven't seen any decreased amount, but if you look at it just from a road safety side of it, dust, even an operational standpoint where you have load restrictions in the springtime, you have, blizzards, Mother Nature throws different scenarios at you. So getting these fluids put into a pipeline system, getting it moved more efficiently, you can get year-round movement away from these well locations. And so there's just a lot of advantages that we see on getting these fluids off the roadways and into a pipeline system.
Does the truck analysis include trucks that haul water?
This analysis was only for crude oil, no water movements.
Okay. Any questions from the webinar? Okay. All right.
Oh, can we just get an update on Dakota Access and Sandpiper?
Yeah, and that was probably a good follow-up to Max's question. I forgot about your question, Max.
Will the Dakota Access pipeline to Iowa help ease some of the truck burden and some of the issues with getting oil to market?
Right. So I guess the first question that was asked was kind of just a status update. Not a lot has changed since last month's webinar. Still, Dakota Access is working through each of the individual states. They'll work with the public utility commissions in each state to determine a route in that state. And so that's ongoing on the regulatory process. The same is true with Sandpiper, still working through Minnesota. On Sandpiper, they do have North Dakota approval from our Public Service Commission, but still working through the Minnesota Commission on that side. So not a lot has changed, still in the regulatory process. As far as the advantages and what's going to take place when those systems go into service, that will provide additional transport by pipeline out of the region. And so with the continued growth that we've seen, we currently do not have enough pipeline capacity to move all the crude that's produced. And going forward, our expectations that crude oil production is going to continue to grow over the long term. And so having systems like Sandpiper, like Dakota Access, are going to provide that necessary transportation to markets around the U.S.
I know Keystone was sort of a specific case, especially because it was coming from Canadian tar sands. But do you see, with the failure of the Keystone pipeline to be built, it being more difficult in the future to get pipelines built, maybe in non-oil producing states, especially?
Well, so the question was, what impact, if any, will Keystone XL have on other pipeline systems? And so in the case of Keystone XL, that was at the federal level for a decision to be made. On the Dakota Access, anything that does not cross that U.S.-Canadian border, that's a state-by-state decision. And so it's a different regulatory environment and different regulators making that decision. So I don't know if that will have any impact on, what's happening in Iowa, South Dakota, or North Dakota Public Service Commission. So it's tough to speak for them, but it is different decision makers in both cases.
So I guess my follow-up to that would be, how have the decision makers in states that don't produce obviously nearly as much oil as North Dakota, have they been receptive to pipelines, or have they fought them a little harder?
Well, I guess the question was, are we seeing different responses from the commissioners in different states? And at this time, I don't know that we have a real clear-cut answer because they're still working through that process. We haven't seen what the outcome ultimately is going to be, even in Minnesota with Sandpiper or in Iowa for the Dakota Access or South Dakota. So I think time is going to tell, what their response is going to be to having these systems moving through their states.
Did you have one, Emily? That was it?
Oh,
Okay. All right. Well, I don't see any more questions on the webinar. Before you leave the webinar, though, I don't know if Justin mentioned it, but he does have a webinar on his website about this evolution of oil gathering in North Dakota. And so it's 4.5 minutes. If you haven't seen it, please watch it because it's well worth your time, and 4.5 minutes is not that long. So check it out. But with that, we will wrap it up. So thanks, everyone. Sorry.
That's what I'll just ask you later.
Okay.
Or now.